Good morning. This is Ken Long from Tortoise Capital with a review of the weekend trading report for June 30th, 2013. We have a market that is in bullish volatile still. On an annual basis, using weekly RSI 14, we're in the middle of neutral at 59 out of 100. On a 10-day basis, we're smack dab in the middle at 50 out of 100 on the 10-day NDX. Looking at the market mosaic, price relative to the 200-day moving average is plus 6.64%, which is yellow bullish. 5-day slope of the 50 at 0.29% has moved up out of the red into yellow neutral. ADX 14, a measure of strength, is at 21.9. The bulls are catching up, but still neutral. ATR percentage at 1.52 remains very volatile. The risk index, which is the 30-period moving average of the VIX divided by the 10, is at 0.91, which is still in risk off conditions. The z-score of that value is minus 1.21 when compared to the last 5,000 days. And you can see the 90-day time series of that z-score with volatility starting to roll over and move up after this double bottom. Still more than one standard deviation away from the baseline. The blended monthly rebalancing portfolios, the 32 ETF portfolio retains financials, healthcare, and discretionary, the sector spiders, and 13 ETF portfolio is going to hold Japan, small caps, and the Dow 30 industrials, with the next reevaluation on or about 1 August. The theoretical exposure of the ETF2 model is at 50%, and the model itself, the model portfolio, will be at 60% exposed and stops respected. A couple useful trading videos were uploaded this week at the YouTube channel. Just a quick look now at the blended monthly rebalancing. It's about half and half for on the buy versus cash position based on the 4-month moving average, and about 2/3 to 3/4 of the larger portfolio were on a buy, or on a cash, excuse me. You see gold way at the bottom of the stack. In the market health check, I uploaded an extended version of this discussion before, but what I would say is that we're right at a turning point still in this retracement period here. We've had 2 lower lows, 3 lower highs, and now we'll see where we're at right here. We're right at in the bottom edge of the river at the 10-day moving average, which is fair value. We still have a ways to go to get to the Bollinger Band mean. I'm concerned because that's a negative slope. We still have to get above 167 in order to really say the bull is back. You can see the 200-period moving average creeping onto the chart. We've come out of oversold conditions into the midpoint of the 10-day range. Percent price oscillator jaws are still open to the downside, but the price action of the last 4 days have helped. Regression line slope is still negative. You can see it's underneath. This is the time series of that. Still underneath the dotted line, the 0 line. And we're in the middle of the RAF regression channel as well. Bulls are starting to catch up to the bears in the ADX, but it's still at a relatively low 20, or 21. These were the concerns that I had on this last pullback. See the material difference between these pullbacks and a bull, which came to the Bollinger Band mean or the bottom of the river, held support, and then quickly reversed and moved sharply higher. In this case, after an extended move up, came back twice to the bottom of the river, was never able to leave the river, and then rolled over here. This one's, I think, important. Regression line 30 crossed over The Bollinger Band mean is the first time in months that happened. You can see all the way up here, the black line was north of that river. And now the 90 period regression line, the Bollinger Band mean, the river itself have all rolled over. We've actually got the beginning of trending behavior to the downside with the slope of the river down, both the 10 in the blue and the 90, I'm sorry, the 30 in black. Both are outside of the river along with price. So this is trending behavior down. So that's something to be cautious about. Looking at the ETF2 summary report, 5 out of 10 of the regions are on cash positions, which puts us at 50-50, slight improvement over last week's 40-60 split. The U.S. at 55 is still better than the globals at 47 in terms of strength. Inside the U.S., the strength is small caps at 56, then large caps at 55, tech at 54, and mid caps at 53. In the sector spiders, 4 out of 9 are on a buy position. The 3 strongest ones, financials, healthcare, and discretionary, all in the green relative to the rest of the world. So that's pretty powerful. World market model, U.S. is all above average, as is Japan. China remains exceptionally above average. The rest of Asia Pacific, below average, less Malaysia and Taiwan. Private equity, above average, but all the other, and oil too, but all the other asset classes getting smacked down. You can see gold and silver especially hurting. Latin America and Brazil, well below average. Emerging markets below average. Now, Europe tipped over and is now under the database average. Last week they were all above. And broader weakness here in the countries of Europe. In every case, the U.S. Business sector is better or tied. There's only one that's even a tie in materials. But every business sector in the U.S. is better than its global counterpart. So definitely strength in the U.S. is broad-based. Review the top 30 ETFs from the ETF2 database. Alternate energy, biotech, finance, pharmaceuticals, regional banks, financial select. It's kind of unusual to see sector spiders in the U.S. this high in the stack, but XLF, XLY, you can see the strength, and then here's XLV. Those are the 3 holdings from the blended monthly rebalancing. Ones that are adding strength here would be those that are in the green in strength, but then white in consistency, which is the 10-week average. So regional banks, and banks. And this limited partnerships have some financial underpinnings as well. So it's looking like banks. Among the Dow, even the weakest 3 are still in the yellow. Nothing red on this stack. Alcoa, IBM, and Caterpillar remain at the bottom, along with material. That whole sector has been lagging, as we saw from the sector spider report. Strength in 3M. It's in the green, plus green and white. Whereas Bank of America, white and green, is actually losing relative strength. Hewlett Packard, Boeing, Microsoft, Cisco, and American Express in the top 5. Hewlett Packard continues to be excellent. And just some reference data here. Looking at the daily trading plan for Monday. See just how volatile this move has been over the last 30 days. No patterns to speak of, but good trades in the auto framer. For gold, Euro-Asia blend, silver, IBM, anti-volatility, treasuries, blended commodities in Brazil. 10-day Max Payne's, IBM, Pfizer, Intel, Travelers, Alcoa. The winners have been Home Depot, American Express, United Health, McDonald's, and Boeing. A couple triple screens here, Cisco and American Express. Top 5 max pain range compressions: Alcoa, Travelers, IBM, Bank of America, and JP Morgan. Lots of quality frogs. And nothing tests out at washed out under RSI2. No patterns among the ETFs. Lots test out at better than 2 to 1 on the auto framer. Coal, Europe, Asia less Japan, Brazil, and Euro-Asia blend are the top 5 in the max pain range compression. Mixed commodities and agriculture come in at single digits on the RSI2. That's why they signal. Interesting moves in silver on Friday. That was one of our shorter term trades that paid off. There's a case study on that on the YouTube channel recently added. In the auto framer, again, this is based on a reward to risk ratio of better than 2 to 1, using a variable for risk. Either we find the middle value of risk between the minimum ATR, which is a quarter, the maximum ATR, which is 1 full ATR, and the range risk, which is the distance from yesterday's high minus the low, plus a 10-cent buffer on either end, or 5-cent buffer on either end, for a total of a 10-cent buffer. Then we pick the middle value of risk in there. So Europe, using a mechanical entry at 39.04, with aiming for a 10-day high of 41.22, would use a range risk plus 5 cents on either end. So a nickel above yesterday's high with a stop in nickel below yesterday's low gives you a 40-cent risk. It's in the middle between 15, 40, and 61 cents. So our risk, or my risk, would be 0.4. And that's what gives us a 5.45 to 1. Mechanical entry would be 39.04 with a stop at 38.64. And that offers us a $2.18 of reward versus 40 cents worth of risk. That's actually, now if you were to take that reward, 218, and divide it by the ATR, you'd find that that's about 3.5 to 1 reward to risk, just using that as multiples of ATR, which makes gold pretty interesting at 5 to 1 as well. Additional indicators: 30-period regression line and the exponential line have come to an agreement of downward pressure. Price is hovering right at the regression line. You can see it's about ready to make a regression line crossover here between itself and its 10-day moving average at an extended period, extended distance below the 6-month average. So that would be an indication of this price here from Monday being a swing low, because it's pulled 1, 2, 3, 4 standard deviations from the steepest point on the curve of the last 6 months. And percent stretch has also made a 3 standard deviation move and now recovered 1 back to the 6-month average. So this would make the argument for this being a stable price area. Now, if this is a swing low, then if that's the amount of risk we're willing to put into that, then we've got a favorable trade on the upside, where we're looking to see price get above 168 in order to resume the bull. And the rest will just be reference data. I want you to notice on the Z-scores for the market, over the last 40, 20, 10, 5 days, only the last 5 days have been positive, positive 2.14%, and that equates to a 0.75 Z-score compared to the last 10 years in terms of what that yield represents. The 5-day average of the last 10 years has been 0.15%. And then plus or minus 1 standard deviation is a boundary at 2.78 and minus 2.48, which gives you this stem and whisker plot. The best 5-day holding period in the last 10 years has returned 19.4%. The worst has lost 19.79%. So that puts the last 5 days of 2.14 into context. That's how you read that chart. Exceptional strength here in Japan, Latin American emerging markets on a relative basis, relative to themselves, along with Home Depot. Slopes of the regression lines, the 30 has turned, is coming back towards the channel. The 10 is back into the channel on the Z-score. The 90 is still in the upper areas of the plus or minus 1 standard channel. Price has re-entered the river here, hovering right on the edge. But again, we've got to see price above 168 for that to become really back to the bull, and then we would expect to see something like that. My concern right now is we have the beginnings of trending downward behavior based on the 10 and 30 regression lines in price, and the fact that the river slope has rolled over. Just more reference data. Just notice the strength in the globals on a relative basis. They're starting to recover. This is the slope of the regression lines of each of these, minus the regression line of S&P. So this is the residual, or the alpha stat. So there may be some stealth trades here in the globals that are available. Again, just some reference data for you. And that's everything I want to cover for this weekend. That's Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.